Good afternoon, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, as always, I appreciate you taking the time to join us today. I think a hot topic that I continue to hear from the field is it is tax season. What kind of tax incentives, tax breaks, any kind of advantages we would have with certain products. So, as some of you know, we had kicked off this tax communication with last week's Mutual of Omaha's call with their advanced markets team discussing the advantages of just long-term care in general. Today, we are thrilled to have Nationwide with us as we're going to talk about the tax incentives for businesses. Today, we have Charlene Werther and Alyssa De La Cruz from Nationwide here to provide us with some details, some tools, and some tips when we're out there talking to our clients and even our potential clients. So with that being said, you guys ready to take it away?
Absolutely. Thank you so much. Thank you so much for having us, Katie. So I will definitely kick it off here for us. Just want to give you just a little note as well. Anything that we've discussed today, there is a white paper, so I know it's a wealth of knowledge, but know that there is a more detailed paper in there, so you have a reference point if you ever need to look back at this. All you really need to know is if I'm working with a business owner, there is plenty of tax advantages, and it's just a matter of how they're set up, and that white paper is a great piece to keep handy so you know how each of these advantages works based on how a company is set up. So I will go ahead and kick it off here, and
I'm going to skip some of these disclosures and head into what we'll be covering today. We'll be going over the structure of CareMatters II. And then what are those options when it comes to tax advantages and where are the most advantageous ones that you're looking at today? The value of an above the line deduction, because I think that's really important to know why this is such an important topic and where that opportunity relies within businesses. The corporate and small business tax advantages for owners, designing a CareMatters policy for the maximum tax advantages there are. And then the consideration that typically does come up is what if the business wants to own the policy? So that does change a little bit of those advantages, but it does come up and we always want to give you that information as well if that's something that topic ends up coming up for you. So let's look at the structure of CareMatters because this is key. Not every long-term care policy or hybrid policy is designed the same. So it is important that you understand what the structure is and asking that question if it is not Nationwide's policy you're looking at and if you are considering a policy out there to understand if this is a possibility with all of those carriers or those specific solutions you're looking at. But essentially, CareMatters II is our product that you have these advantages on. Unfortunately, you don't have them at the moment on our LTC rider. If you use our UL policies, VULs, it's not designed in a way to allow for this possibility. So CareMatters II does offer this option where we're able to separate the fixed premium for the life insurance and the long-term care premium. So they are separately identifiable, and that's what creates those tax advantages. So you're going to see that the life insurance premium is not deductible in this case. In most cases, you'll see where there is some opportunity in a different capacity where it can have some tax deduction. And then the long-term care premium has its own tax deductibility. And that will include, because CareMatters is broken up in a couple of different ways, essentially all the solutions that you choose will have a premium for the LTC rider, the extension of benefits. Essentially, if you own a policy that covers more than 2 years of benefits, so we offer up to 7 years of benefit durations, then there's a premium for there. And then if you also have chosen inflation, there will be an additional premium there that can be added for that potential for that tax deductibility. Now, I always think this is a good one to definitely have a good understanding about what the value of that above the line deduction is. So let's take a look here. So simply to kind of keep it easy, the above the line deduction is taken directly from the gross income that helps establish the adjusted gross income, so your AGI. You can take this deduction whether you itemize it or not. One advantage is the business owners will get the qualifying LTC deduction as an above the line deduction. And this is not subject to a 7.5% floor that you would usually see if you were to do this individually as an individual taxpayer if you didn't go through your business as an option for this. And it could also be subject to age-based limits. So there's a couple of things to keep in mind where that comes into play, and that's where the value is, where the above the line deduction is. You're able to get that before and take it off that overall AGI. Now, where the below the line deduction is it's subtracted from the AGI after the fact, after it's already been established. Some below the line deductions can only be taken upon reaching a floor percentage of the AGI. And it also requires that you itemize your deductions. So that's why we meant, and that's where that power is of that above the line deduction. It's considered more valuable to a taxpayer. So it is something that if you have a client or business owner, or even talking to their tax advisor, an above the line deduction is extremely attractive to them. Now let's take a look at where that value is. There's definitely a value in each of these scenarios. They're just going to be held at a different benefit, or where you really see the most value. So going from the left side of your screen to your right, the most valuable opportunity, and something certainly worth mentioning within your book of business that or clients that you work with, are businesses that purchase on behalf, they're a C Corp, they're established as a C Corp, or they're purchasing on behalf of employees. So maybe they're trying to retain their employee, and this is a benefit they're wanting to look at. So whether they're a C Corp or not, if they're a C Corp, for sure they're going to get this benefit, have that opportunity, or if any kind of business is trying to purchase this on behalf of an employee. That's because the LTC premium is 100% tax deductible as a business expense. So there's not these floors you have to adhere to, or age-based limits that the IRS has guidelines for that they'd have to adhere to. So this is why, if you have those opportunities, if somebody's trying to retain an employee or they're a C Corp, huge opportunity for them. The next valuable opportunity is pass-through entities. So are they self-employed? Could be one as well. This could be a health insurance deduction. So that LTC premium does have a tax deduction. It does have a limit, so it is an age-based limit. So I'll show you in a moment what those limits are based on an individual's age. They still have that tax deduction. There's just a limit to it, not where you were seeing in that column before with a C Corp or a business purchasing this on behalf of an employee. So if it's a pass-through entity looking just to cover themselves as owners, or they're self-employed, something to that degree, there might be a limit to it, but still valuable. Your next valuable option there is somebody that maybe isn't self-employed, doesn't own a business, something to that degree. They are looking to purchase this on behalf of themselves. They still have that opportunity to have a tax deduction, but now there are two things they have to meet. There's an age-based limit, and they are subject to that 7.5% floor. So they have to have out-of-pocket medical expenses. If you make $100,000, those out-of-pocket medical expenses have to be $7,500 or more before you can even get this tax deduction. So anything above that has that potential. But again, that can be a challenging one if somebody doesn't have a lot of medical expenses to hit that every single year. Still valuable, but that's where we're really showing you where those advantages could be in the business capacity. And then your next valuable option is somebody that has an HSA. I think that's a great opportunity to always talk about somebody that has a HSA and ask, are you contributing to this? It's a phenomenal tax vehicle for retirement and healthcare costs. But also on top of it, it may be an additional topic to bring up to say, did you realize you can get some of those LTC premiums paid through your HSA? And in that case, there are some things you do have to adhere to. So you still have that age-based limit that you have to adhere to. So there's a limit on how much you can get reimbursed from your HSA, but you no longer have to hit that 7.5 floor. So that can be more attainable for somebody. Maybe if they don't have those medical expenses and are unable to do that tax deduction, they may be able to use their HSA. And the nice thing is that you don't have to do this every single year on the HSA capacity, on the HSA component. You could shoebox those receipts and say, hey, maybe I'm just going to keep my HSA growing. I don't really have a need to take out that LTC premium, but if I do need it down the road, I essentially have my annual statements that say I've been contributing premium into this policy, and now you can have a nice bucket down the road, maybe in retirement. Maybe your HSA account is doing really well. You don't necessarily need all of it for that, and you're able to access it to say, hey, I've been paying 20 years of LTC premium. I can calculate what that is and say, hey, I've been paying it. I would like to take that out now. You do have that ability. So that's a nice way, even if they aren't able to utilize that tax deduction, to down the road say, hey, I'm going to come back to this later if I don't want to do this every single year, and collect that, 20, 30 years down the road if I wanted to. Now let's take a look at how this would play out. An example. So maybe an employer is going to carve out a select group of employees to offer long-term care. So in this case, let's see how this would work. So the employer will pay all the premiums directly to the insurance company to purchase an employee-owned, so the employee is going to own this CareMatters policy for these employees in the group that they've carved out here in this case. So this is what it will look like. So the insurance premium is treated as compensation bonus. So that is 100% tax deductible to the business as a business expense. Now this portion of it will be taxable to the employee because it's seen as a bonus or compensation received. There are times where we have seen maybe even the employer, if they don't want them to realize that taxable gain, that maybe they bonus them also to be able to cover some of those taxes as well. So that is an option too, if that is of concern. But the key point would be here is really where that opportunity is, where that benefit is to the employee here is the LTC premium. So it's treated as payments for accident and health. So again, the LTC premium is tax deductible to the business. There are no age-based limits, so they have that full amount that they can utilize. The LTC premium is also excluded from the employee's income, so they're not worrying about taxation here, and any growth or benefits that they receive from the policy is tax-free per IRS guidelines. Additionally, if you would like to include spouses and dependents, I've seen this happen as well. Maybe they're all, I've had owners include their spouses and key employee spouses as well as something that they were trying to offer as a way to retain these employees. Now, the key point to how this would be utilized and being able to maximize these tax advantages, you want to keep in mind the employer cannot have any ownership or beneficial rights to this contract. If they do, this does change this. All right, let's take a look here through pass-through entities. So I did mention where that C Corp, or if you're purchasing this on behalf of an employee, like a carve-out situation, that's really where that advantage was, and that was on that last side. That's why it's the most valuable tax advantage opportunity there is, but there's still a great opportunity for pass-through entities. So something you want to keep in mind here is there are going to be age-based limits that you're going to want to look to. So self-employed individuals may deduct qualified LTC premiums as an above-the-line deduction. They are not subject to that 7.5% floor that we mentioned if you were to do this individually and wanted that tax deduction. They can still include their spouses and dependents, but these are the limits that they're adhering to, whereas that C Corp or someone purchasing on behalf of their employees would like to do this, they could have, if that LTC premium was $5,000, they can get that deduction for $5,000. For an age-based limits in these pass-through entities, it will depend on their age. So if this individual's, again, that example was 5,000, if they were 61 through 70 or 71 plus, then majority, if not all of it, would be covered in that case to be as a deduction. If they were younger, as they got older or they had like a longer premium, then sure, it can continue to increase, but there is a limit to that. So you could see where that is something you want to keep in mind. So maybe we are doing a pay to 100 and this employee's 41. As they age, that number is going to continue to increase. It may not look super advantageous initially if they're 40 through 50, but there's still a good opportunity there. Now, there are things you do want to keep in mind. Each entity has a slight variation on how premiums are paid and labeled for. So it's just going to vary. What I would recommend is always, if you do have that question, reach out to Katie. She may reach out to us, or you can reach out to us at Nationwide, Charlene, Justin, or I, if you have those questions. All we really need to know is how is that entity set up and what is their goal? Are they trying to carve out for specific employees? Are they just trying to carve out for the owners? Whatever it may be, just let us know what that goal is. And we can always double check with our advanced consulting team. That is one of those advantages you have with partnering with Nationwide. We have a team of lawyers who really look at all of these high level topics and can give you some information and guidance to say, this is going to work in the best way because of XYZ. What you are looking to do does work, or if it doesn't, hey, these are some pitfalls. If you do it this way, that may be of concern that you want to double check as well. So it's a great way. We don't expect you to be an expert in everything, but you know that if there is an opportunity for a business owner to purchase long-term care, that's all you really need to know at that point. And we can take it from there to say, will this work? Won't it work? How can we help you? And what are some pitfalls if this scenario goes to fruition? Now, the advantages of buying CareMatters through a business, there are a couple of things to consider, because I truly do understand that that may come up where I'm just going to do this on my own. Why do I want to go through my business to do this? These are some things you want to keep in mind. So for a C Corp, those advantages are, if you did this individually, you do have age-based limits and you do have that floor you have to meet. If you went through a business to do this, there are some things you do get those advantages. It does not matter how you structure the premium schedule. There are no age-based limits, so you have those full deductions, and that's a great advantage there, because if you're not in one of these scenarios, the concern there is if you have let's say you wanted to do a single premium, but you have to adhere to age-based limits, it's only every year you're paying a premium that you're able to get that deduction. And you only get that limit. So remember, that individual that was, let's say 45, is only getting $850. Well, if I did a single premium of $100,000, I'm only getting $850 back as a tax deduction. Not super great. I'm going to want to design that a little bit differently. But if it was a C Corp and I know my LTC premium was $50,000, it does not matter how I structure that. I don't have no age-based limits. I'm getting that full deduction of that $50,000. If I do have to adhere to age-based limits, like a potential pass-through entity would, or if I went through it individually, I only get that $850 once, and that may not be advantageous to me. I may want to structure it a little bit differently. Now, for a pass-through entity, something you want to consider, what is that advantage is, one, if they did it individually, because that does come up too. What if I'm a self-employed individual? Maybe I design homes for a living. If I went through it individually and said, I'm just going to use my personal accounts, I'm not going through my business. Well, one, do I have those medical expenses? Because I'm subject to that 7.5% floor. So remember, if I'm making $100,000, do I have medical expenses of $7,500 or more before I can get that ability to have some kind of deduction? And I'm also adhering to an age-based limit. Not super attractive. That may be difficult. And if I'm self-employed, chances are I don't have an HSA, so I also don't get that option. But if I went through my business, guess what? I don't have that floor to meet. I do still have that age-based limit, but now I have that opportunity for a tax deduction where, had I done it individually, I didn't, because I didn't have the medical expenses or I didn't have an HSA that I had access to. Now, considerations you want to keep in mind is, with those C Corp owners and employees, shorter premium schedules. I understand why you may choose that, because obviously the shorter pay, you have some more LTC coverage and leverage. But something you want to keep in mind is it has to be a premium that's considered reasonable and necessary, because remember, it is a bonus. So if you're trying to retain an employee or you're trying to purchase this for owners, if they're making, let's say, $50,000, and I'm purchasing a policy that has a single dump in of 100,000, not what probably would be considered reasonable and necessary. So that may not make a lot of sense, is why you're bonusing somebody $100,000 in that given year. You may design it a little bit differently and say, okay, I'm going to do a policy for $10,000 for 10 years, still that same $100,000, but that looks more reasonable to have a bonus of $10,000 a year, opposed to a dump in of 100. So those are things you want to consider. Again, these are things that the Nationwide team can point out to you, depending on how you want to structure things, that we will point out and mention Does this make sense, or should we change it up? Now, for pass-through entities, some things you want to consider is, because you have those age-based limits you have to adhere to, longer premium schedules are worth considering, so you can capture more tax deductions. Because again, if that employee is young and they're getting $850 for those next 10 years, I want to capture that potentially, especially if this is going to be a sale for those tax advantages. I want to capture that $850 deduction 10 times versus once. So those are things you want to consider versus now I understand that may change the LTC benefit, so that's something to consider versus a larger LTC benefit with, let's say, a single pay where you only got that $850 deduction once. So sometimes it's knowing the client and what's valuable to them. Is it more valuable for the LTC coverage, getting the most for my dollar, or I really do like those tax advantages, and that sometimes is that leading factor to somebody. It's important for them to have those tax advantages and combine it with the ability to make sure they're covered long-term care wise. So those are things you want to consider as well. Now, what I'm going to show you here is what I mentioned is how you structure the design of this is also going to be important. Again, Katie, the Nationwide team, is happy to help you because we are aware of how this plays out, and we want to make sure that this benefits the employee as well as the employer that's looking for those tax deductions as well. So this is where we're mentioning how inflation can come into a very key point in how you can really maximize that tax deduction. So we're going to look at a 50-year-old male, non-tobacco, he's married, he's paying $20,000, or the corporation is paying $20,000 for 5 years with a 6-year benefit. We're going to say this is a C Corp. There's a lot of numbers here, but we're going to focus on the ones that are in colors, because this is where those deductions are going to come into play. And also potentially even looking at the benefits. So with the no inflation, I'm going to say at 50, he certainly should have inflation, but just so you can see this concept play out, he's going to get a benefit of $500,000. Essentially, it's going to pay almost $7,000 per month, never going to grow from there. That's what it'll always be. That life insurance premium is $17,736. Now let's scroll back down to the bottom where it's in red. Now remember, to the employer, they get a tax deduction. They're going to get this whole thing as an opportunity for a tax deduction. What we're trying to focus on is how do we protect that employee in this case, because there is something that they're taking responsibility tax-wise unless the employer is bonusing them to cover some of that. But assuming that they're not, remember the life insurance premium, which is $17,000, is included in the employee's taxable income because it's paid as compensation. So I'm looking at $17,736 that is being included as the employee to my income. And then that LTC premium that was not being included in my income as an employee, it's excluded, is only $2,200. Still not a bad deal, but could we do this a little bit better? So let's take a look. So if I did a 3% compound, one, yes, my starting benefit's $5,200 that you can see on the third line down, but inflation makes sense because at age 80, when maybe a typical claim may occur, that benefit's increased to $12,700 versus the $6,900 that we're seeing with the no inflation option. So clearly at his age, it does make sense to have some form of inflation. But let's scroll down to the bottom in red. Well, now we've switched some of that premium there of that $20,000. Now $13,000 is being included into their compensation, which is taxable to the employee. Now what's excluded is $6,500. That looks better than the first column that we looked at. Let's take it up one more level because this individual could also benefit from a 5% compound. One, yes, the starting premium the starting benefit is $3,800. Now this is where you may kind of debate, well, is that too low for me? Maybe not. But also at age 80, maybe when a claim may occur, my benefit's $16,600, more than the 3% compound. So clearly the growth is still working for me. It just may be a one or the other that I might be looking at what do I think is more beneficial to me. But let's look at that taxable income that's going to be put on that employee. By using the 5% compound, because there is more cost there to have that inflation, more is included in the LTC premium in this case versus the life insurance. Now we've dropped it to $9,800. So that's the lowest of the three that's being included in the employee's income. And then the LTC premium, which is excluded from the employee's income, is $10,100. So that's where we mentioned that the design is going to be very important. Now, depending on the individual's age, this may come and go, if this individual's closer to 70, then maybe we do have to still consider the no inflation option. But this is where we can weigh some of those options and say, where can we minimize as much of an impact to the employee's income that they're going to be responsible tax-wise. Now, another question that does typically come up is also, well, what if this business owner wants to own this policy? So we mentioned a lot of those tax deductions in the previous slides of where it was important that the business does not own the policy and is not the beneficiary of the policy to get those tax advantages. Now, we truly understand that an employer may want to own it for a couple of reasons. They may want to control the cash value. They want to maybe use it as a retention tool. They may also want to be the beneficiary of the death benefit. So there's a lot of reasons this may come in to fruition. Now, in these cases, specific tax deductions available for the long-term care premium paid by the business will depend on the type of business entity and whether or not the insured or participant is an owner or an employee or a non-owner employee. So those are things you want to consider. There are a couple things I'm going to show you in the next slide. It just kind of depends. There are some things that may change on that regard. So if that is something that they're truly looking to do, that's a conversation we want to talk about as well, because it does work a little bit different versus doing maybe a life insurance policy where someone may want to do some kind of a REBA or something to that degree. Let me click here to your next slide. So what tax deductions are available? So the calculation for the tax deduction for LTC premium of a business-owned policy will follow the rules that we previously described based on how that entity is set up. But you want to keep in mind that the business may not take a tax deduction for the life insurance premium. So because if they're considering being the owner, that's something that they need to consider, that they're not going to have that ability to take that tax deduction that they were able to in that case. Or if they are a direct or indirect beneficiary of the policy. So those are things that you want to consider. That if that tax deduction is a huge component to them, they may say that might need to be explained that you may not want to be the owner of the policy in that case, because it's going to take away that leverage that you have. Now, if and when the business chooses to transition ownership to the policy of the policy to the employee, because that may come up, they may say, hey, I'm not really to give them access to this for at least 10 years. That may be something that they want to do. At that time, the fair market value of that insurance component will be deductible to that business as wages. So it's going to be considered like a bonus, and then taxable to the employee as wages received. So those are things to consider. It's still a potential that they'll get it. They just won't get it at the time that they're paying premium. So that may be okay with them too. Now, no tax deduction is available for either the long-term care premium or the life premium for a non-employee or owner. So like a silent partner. Owners must be a bona fide employee in order to qualify for these tax advantages. Now, businesses must comply with the notice and consent requirement of the IRC Section 101 due to the life insurance component of the policy. So that's something you want to consider. So these are other things you want to keep in mind. Should a long-term care claim occur, and again, if the business owner is trying to own this policy, the benefits are paid tax-free to the business. They are subject to IRS limitations since they own the policy. Benefits are paid as accident and health benefits because CareMatters II is it's considered an IRC Section 7702B policy. The employee will receive those benefits tax-free from the business as an accident and a health benefit. So that's something to keep in mind. Other things you want to keep in mind is ERISA requirements and potential for a 409A classification must be considered if you're going to go that route and want to own the policy. Again, these are two different scenarios. What we talked about earlier is if the business owner isn't the owner of the policy or a beneficiary of the policy, that's where they're going to get the most maximum tax deductions. If they do want to, because they want to use this as a retention tool, there are a lot more things that they're going to want to keep in mind, and some of those advantages may change slightly, but we can obviously have those conversations in depth to know what is their goal and weigh both of those options to see which one makes better sense for them and their situation. If I can leave you with anything, is that business owners can really maximize their tax advantages by purchasing CareMatters through their business. Tax deductions make these policies more affordable to them and more desirable to purchase. So this may be a different way to hold a key in your pocket as planning potential for long-term care. Sometimes individuals love that tax deduction, and that may be that way to entering that conversation as, hey, I can show you ways that we can, one, protect you for the long-term care event that you may be facing in the future, but also give you those advantages that might be important to you. Business owners are afforded more liberal tax advantages versus individual taxpayers. So we went over that, where you kind of saw that obviously if you're a C Corp, you get all these deductions at 100%. But if you are an individual looking to get these tax advantages, they are attainable, but it is a little bit harder to receive because you have those floor requirements plus the age limits that you have to adhere to, where that doesn't really come up as a business owner. Obviously, C Corp is going to get the most advantage there. The pass-through entities are able to avoid that floor, so that still gives them access to some tax advantages quicker and more easily than an individual taxpayer. And most importantly, if I can leave you with anything, is why you would consider CareMatters II is because it is a cash indemnity benefit. It offers that policy owner or business owner that they're considering this to really maintain the choice, control, and flexibility that they're looking for. It is not something that I feel is something you have to really resell later on. They know exactly what they're getting in their benefit. If it says you're getting a $10,000 a month benefit, that is what you're receiving unless you tell us otherwise. And you can use it however you deem necessary, as long as your doctor is okay with it. So if that means my spouse is going to take care of me, my family is going to take care of me, or anything else that's really created in the future, because it's really hard to say what long-term care kind of a treatment and care being provided 30 years in the future will look like. Knowing that your policy can grow and change with you is really beneficial, and it really allows for the most flexibility that you're looking for, making it a solution that can deliver a solution to your business owners that is a little bit different than reimbursement that may have a little bit more red line that you have to adhere to, that may make it a little bit difficult to get to those benefits. I will leave you with our sales desk number if you have any questions, but I do also want to make sure I get you Premier Marketing's number as well in case you have questions as well. I definitely would encourage you to reach out to Katie and her team because they are phenomenal and very knowledgeable. And if they need to loop us in, they gladly will. So that number is going to be 800-365-8208 with the extension 12226. Again, that's 800-365-8208. Thank you so much for your time. If you have any questions, please don't hesitate to reach out. We know we gave you a wealth of knowledge, but knowing that if I had to give you anything to keep in mind is that there's just so much opportunity when it comes to business owners. And this is the perfect way to have that conversation, especially with tax season upon us. It may not be something that they're going to benefit for this tax season, but it's certainly something that they could benefit from in future tax seasons. Thank you so much for your time. You have a great rest of your day.